Hello all. This is a presentation on our research paper When Rain Matters, Investments and Value Relevance, along with Dr. Chandra Thapa, Dr. Santosh Koirala, and Dr. Suman Neupane. Studies focusing on weather-related anomalies have been attracting global attention in both practice and academia. Evidence suggests that higher precipitation levels, which are directly linked to escalating atmospheric temperature, is one of the main factors contributing to climate change conditions. Studies document that the exponential increase in the water holding capacity of air with rising temperature, as supported by the theoretical modeling of the Clausius-Clapeyron relation, results in the intensification of water cycles. A recent study by NASA's Jet Propulsion Laboratory found that for every 1 degree Celsius rise in ocean surface temperature, 21% more storms were formed, which means a substantial increase in extreme rainfall. Worldwide statistics show that in recent decades, the frequencies of disasters such as floods and droughts have been distressingly intensifying, particularly in Asia. For example, between the years 2000 and 2018, flooding and droughts conditions in India have incurred losses of around USD 48 billion and USD 5.6 billion respectively. An overwhelming weight of accumulated research corroborates that changing climatic conditions in recent years have led to the widespread dislocation of population along with lower agricultural income arising from loss of crop and livestock, higher unemployment, and poverty. The ramification of climate change carries significant negative consequences for economic growth and development. Within the literature of finance and changing climatic conditions, we see investigations using hurricanes and natural disasters and increase in atmospheric temperature as exogenous climatic variations. However, we do not find many studies which use extreme rainfall conditions to conduct their empirical investigations. Furthermore, most of the studies in finance specifically focuses on areas relating to environmentally sustainable practices, using climate legislations and their impacts, and what are the influences of climatic conditions and changes in climatic conditions on stock markets. However, there is very few studies in literature which looks into the impact of changing climatic conditions on the firm's investment policies. In this investigation, therefore, we look at rainfall conditions and the impact it has on the firm's investments and firm value. In the rainfall conditions, we have three heterogeneous conditions. One being the normal condition, two being the excess rainfall condition, and three the deficit rainfall condition. So the investigations looks into what is the impact of the excess rainfall condition on the investments and firm value. Similarly, we also look into the impact of deficit rainfall conditions on investments and firm value. Whether these exogenous conditions of rainfall departures, that is, the excess and the deficit condition, lead to an increase or decrease in investments or firm value. Therefore, our research questions are as follows. What are the valuation effects in the immediate aftermath of these extreme rainfall conditions? How do these firms react with their investment strategies following such extreme rainfall conditions? Whether the investment strategies induced by the extreme rainfall conditions are associated with variations in market valuations of rain-sensitive firms. We first develop our hypothesis on immediate value decline proposition. Since rainfall deviation lead to economic distress conditions and excess rainfall could also lead to destruction in asset values, this can have negative impact on economic activities and outputs. Further, the damages that are caused by the excess rainfall conditions on the physical infrastructure can put tremendous pressure on the earnings capabilities of the companies. Deviations in rainfall, either the excess or deficit condition, can also impact the aggregate consumption and rural demand, as well as resulting in the overall reduction in the market demand for products and goods. Further, excess conditions, which also disrupt supply chain, could also mean that the supply conditions are also impacted. Given that a firm's price reflects information about the future cash flows under normal circumstances, we propose our first hypothesis, which is, following excess or deficit rainfall conditions, firms belonging to excess or deficit rainfall industries should experience an immediate decline in their firm value. In the immediate aftermath of extreme rainfall departure, managers of rain-sensitive firms face a capacity investment decision scenario whereby they need to respond in managing uncertainties and future demands. Importantly, as investments are generally irreversible, firms must carefully assess their investment strategies following the uncertainty and distress caused by the extreme rainfall departures. Considering that the corporate investment decisions are a measure of risk-taking, two competing views in the theoretical corporate finance literature examine the issue of risk-taking under uncertainty and distress. First, which is the real options approach to investments, posits a trade-off between making immediate investments and delaying them in order to gain more information. As the value of delaying investment decisions increases with higher uncertainty, as would be the case following extreme rainfall departure, the real options framework conjectures a decrease in investments. Second, the risk-shifting view posits that firms are more likely to take riskier investment decisions during the time of distress. As per this view, since excessive risk-taking enhances the possibility of disproportionately benefiting the shareholders in the wake of firms facing uncertainty and financial distress, managers tend to move away from safer to riskier assets. Since extreme rainfall departure conditions generate uncertainties and enhance financial distress, the risk-shifting view implies that investments among rain-sensitive firms should increase. As is evidence, both the above discussed traditional corporate finance views do not provide a unified framework to examine investments when firms experience heterogeneous conditions of excess and deficit rainfall departure. The possibility of firms pursuing different investment strategies in the aftermath of heterogeneous rainfall conditions is to a considerable extent addressed by the salience theory of choice under risk, which predicts investment strategies based on the saliencies of the past experiences encountered by the managers. Proposed by Bordalo 2012, salience theory states that decision makers are risk-seeking when they see the upside payoffs for such decisions to be salient, and risk-averse when its downside is salient. In our context, it is reasonable to argue that local firms, particularly the rain-sensitive ones, would be more attentive to the saliency of the rainfall departure. Since salience theory dictates that investment choices are context-dependent, the excess and deficit rainfall departure conditions present a different risk-return frontier for the rain-sensitive firms, presenting a rational manager with differential opportunities of pursuing the investment strategies. A utility-maximizing manager should respond to such differential investment opportunities with the ultimate objective function of maximizing the firm value. In other words, the managers should boost investments when the rainfall departure triggered opportunity window is favorable and deter from making investments when the opportunity window is unfavorable. However, both strategies, when followed, will result in the same objective function of maximization of the firm value. Given this, we develop our second hypothesis, which is following excess deficit rainfall, firms belonging to excess rain sensitive, deficit rain sensitive industries should decrease their investments. Our next set of hypotheses is based on the value relevance of the investment strategies adopted by the managers. We have two views. While the first view takes that the fiduciary duty of managers to make investment decisions should be to maximize the shareholder returns and that the firm value of the firm increases with increased corporate risk-taking, we conjecture that an increase or decrease in investments following excess or deficit rainfall conditions should increase the firm value. On the other hand, irrational investments due to managerialism and agency problems can also be value destroying. Given this set of schools' views, we also develop the alternative hypothesis, which states following excess deficit rainfall conditions, firms belonging to excess deficit rain sensitive for industries that either decrease or increase their investments are associated with lower firm value. The time varying rainfall data is obtained from the IMD, Ministry of Earth Sciences website. We use the subdivision level rainfall departure data of the Indian monsoon season for this period. IMD computes the annual, monthly, seasonal, and annual rainfall statistics for 36 meteorological subdivisions belonging to different states of India based on the daily rainfall obtained from 3,500 rain gauge stations spread across India. For each of the 36 subdivisions, IMD also calculates normal or expected rainfall using records of 50 years, that is, from 1951 to 2000, for a network of 2,412 stations all over India. The normal value is the independent 50-year long period average rainfall recorded during the monsoon season. For each subdivision, based on the difference between actual rainfall recorded and the expected normal figure, IMD computes the percentage of rainfall deviation referred to as rainfall departure hereafter. IMD considers rainfall departure above 19% or below 19%, the minus 19% relative to the expected normal to be the excess or deficit rainfall condition. This implies rainfall departures within the range of plus or minus 19% are normal conditions. We use a slightly different approach in our classification, where we first sort the percentage departure of rainfall and then divide them into quintiles. We consider the upper quintile to be the extreme excess rainfall condition and the lower quintile to be the deficit rainfall condition. For all our firm level data, we use the Proves database. This table shows the complexity of rainfall departure during the monsoon season in 32 rainfall subdivisions of India from the years 2000 to 2017. As evident, the intensification of rainfall departure significantly varies across years and subdivisions, whereby the extreme rainfall departure figures provide us a credible exogenous variations. We present the rainfall departure using different shades of red and blue to provide a visual perspective of the complexity and changes in the intensity of the extremity. The different shades of red cells represent subdivisions with the deficit rainfall departures below -15%, and shades of blue represent subdivisions with excess rainfall departures above 15%. Uncolored cells represent subdivisions with normal rainfall conditions. The four different shades of blue and red cells changing at every 5% deviation indicates the varying intensity of rainfall departure. As an identification strategy, we use a difference in difference approach. Here we have normal periods, and then we have the departure rainfall period. But the departure rainfall periods are again classified into excess departure and deficit rainfall departure periods. So for the purpose of our difference in difference, the pre-crisis or the pre-shock event period is the normal period, and the post-crisis or the post-shock event period is the departure period, which is either the excess or the deficit conditions depending on the specification. Again, we have two treatment groups. First, depending on the sensitivity of the industry towards the excess rainfall condition, we have classified all those industries which are sensitive to the excess conditions as excess rain sensitive treatment group. Then we have the second treatment group depending on whether a certain industry is sensitive to the deficit rainfall condition. Now all these sensitivities of the industry is identified through an extensive literature and also is supported by a set of empirical investigations. Now we test our first hypothesis, that is, what is the impact of rainfall deviation on the value of the firm, the immediate value decline proposition. For this, we use the monsoon season, that is the Q2 for financial year. And then we run the specification for the firm value. And we find that in both excess rainfall as well as the deficit rainfall condition, the market to book, which is a proxy for the firm value here, is significantly negative. Next, we test the second hypothesis, that is the impact of rainfall deviation on the capital expenditure. For this, we begin with the univariate difference in differences. Our results indicate that the DID coefficient is significantly positive in case of excess rainfall departures, and it is significantly negative in case of deficit rainfall departure. Further, the multivariate regression DID also confirms the univariate analysis results. We see in case of excess rainfall condition for both full sample as well as subsamples, which includes different types of robustness samples. For the excess period, the coefficient is positive and significant, and for the deficit periods, the coefficient is negative and significant. Further, we also conduct some rainfall sensitivity analysis by increasing the extremity in rainfall beginning from 15% and moving up to 30% for excess rainfall, and beginning at -15% and moving down up to -30% for deficit rainfall condition. It can be observed that in case of excess rainfall, the significance starts at 23% and above, whereas for the deficit rainfall condition, the significance begins at -18%. These figures conform to our quintile ranges of rainfall extremities. Our results are supported by a battery of robustness checks. This includes using alternative measures of investments, using the rainfall persistence analysis, using alternative treated and control groups based on geography placebos, as well as using 1-year paired DID. Now we test our third hypothesis. If the saliency theory holds good, that means the firms which increase their investments in the excess rainfall period must see an increase in the value in the post-rainfall conditions, as well as the firms which avoid investments or reduce their investments in the deficit rainfall condition period should also see an increase in their firm value in the post-rainfall deviation. We test this conjecture in this third hypothesis. We find that for both excess and deficit rainfall conditions in the post period, the value of the firm is positive and significant. This is in conformity to the predictions of the saliency theory. Further, as a robustness check, we use Tobin's Q and find that the results are also confirming the hypothesis 3. To summarize, in this research, we look at the impact of rainfall departure on the corporate investments. The rainfall conditions are heterogeneous and includes the excess rainfall condition, the normal rainfall condition, and the deficit rainfall condition. The excess and the deficit conditions are the two rainfall departure exogenous conditions. Our investigations support the propositions of the saliency theory. We show that in the excess rainfall departure, the firms which are sensitive to excess rainfall increase their investments, whereas in the deficit rainfall conditions, the firms which are sensitive to deficit conditions reduce their investments. Both these investment strategies ultimately leads to an increase in the firm's value. In summary, the key findings of this study are: firm value declines in the immediate aftermath of extreme rainfall deviations. In the deficit rainfall conditions, firms in rain-sensitive sectors reduce investments, while in excess rainfall condition, they boost investments. The differential investment strategies adopted by the firms in the heterogeneous rainfall extremities are very relevant. We contribute to the literature of climate change and climate corporate finance. Thank you. We encourage you to read our paper in the link given below.